Oil is back above $100 a barrel. But this is not just a price move on a trading screen. It is the global economy discovering the price of fear. This time, the shock is not coming from a banking crisis, a pandemic rebound, or a normal OPEC dispute. It is coming from war, blocked shipping lanes, damaged energy infrastructure, and a Strait of Hormuz crisis that is forcing markets to reprice oil, inflation, growth, and political risk all at once. And if this shock lasts, the cost will not stay in the Middle East. It will move into fuel tanks, grocery bills, airline tickets, shipping contracts, factory margins, central bank decisions, and election campaigns across the world. That is why this story matters beyond the Middle East. Oil is not just a commodity traded by specialists in London, New York, or Singapore. It is the hidden input inside transportation, food prices, plastics, shipping, aviation, electricity, manufacturing, agriculture, and inflation expectations. When oil moves this sharply, the world does not simply pay more at the pump. The entire cost structure begins to shift. A higher crude price becomes higher diesel becomes higher freight becomes higher food and retail costs. And before long, a naval crisis thousands of miles away starts showing up inside ordinary monthly bills. According to current market reporting, Brent crude has moved near the $105 level, while West Texas Intermediate has also surged. But that price does not exist in isolation. It reflects fear that the Strait of Hormuz, the passageway for roughly one-fifth of global oil flows, may not normalize quickly, even if diplomats eventually restart negotiations. The market is not just pricing oil, it is pricing the possibility that energy can no longer move safely, predictably, and cheaply through one of the most important corridors on Earth. And that is the key. Markets are not only pricing what has already happened, they are pricing what could happen next. A longer closure, more seizures, more mines, more attacks on infrastructure, more insurance costs, more naval escalation, more shipping delays, more uncertainty over how long this crisis can be contained. Oil traders are not waiting for certainty. They are buying protection against uncertainty before the public fully catches up. That is how fear becomes a price. The International Monetary Fund's April outlook reportedly framed the global economy as living in the shadow of war. That phrase matters because it tells us something about the baseline assumption. War is no longer a side risk sitting outside the forecast. It is becoming part of the forecast itself. The important part is not only the phrase, it is the assumption behind it. The global economy is no longer being judged as if conflict is a temporary headline outside the model. War, energy disruption, damaged infrastructure, and geopolitical fragmentation are becoming part of the economic baseline. That is a very different environment. S&P Global has also cut its 2026 global growth forecast to 2.4%, describing it as the weakest rate since 2009 if the pandemic collapse is excluded. That matters because high oil prices are now landing on an economy that was already slowing. This oil shock is not hitting a booming global economy. It is hitting an economy already losing speed. Growth is weaker, debt is higher, consumers are tired, governments have less room to cushion another shock, central banks are still trying to prove they have inflation under control, and now energy prices are threatening to reopen the wound. This is how a regional war turns into a global economic problem. The fighting may be concentrated in one part of the world, but the energy system is global. A tanker delayed in the Gulf can affect refinery margins in Asia. A higher diesel price in Europe can affect trucking. A higher jet fuel cost can affect airlines. A more expensive shipping route can affect food, electronics, machinery, and consumer goods. The chain is long, but it is real. And when energy is the first link, the entire chain feels the pull. The story is not simply that oil is expensive. The story is that expensive oil has arrived at the worst possible time, after years of inflation trauma, while central banks are trying to regain credibility, while governments are carrying heavy debt. while voters are already angry about living costs, while companies are still rebuilding supply chains, while political systems across the world are already under pressure. That is what makes this shock politically dangerous. A normal oil spike hurts. An oil spike in a fragile economy changes decisions. To understand the scale, start with Hormuz. The strait is not a normal maritime route. It is the exit lane for much of the Persian Gulf's oil and liquefied natural gas. Producers can use some alternative routes, but not enough to replace the strait quickly. When Hormuz is threatened, the market does not ask whether every barrel is blocked. It asks whether enough barrels are at risk, and that question alone can move prices before the physical shortage becomes visible. Oil markets are forward-looking. If traders believe future supply is uncertain, prices rise before the shortage is fully visible. If shipping companies hesitate, physical flows slow. If insurers raise premiums, the cost of transport increases. If tankers reroute or wait, refiners start planning around scarcity. If governments fear shortages, they begin weighing reserves, subsidies, emergency measures, and diplomatic pressure. This is how fear becomes a price. And in a crisis like this, price becomes a warning signal before the public fully understands the danger. The U.S. blockade of Iranian-linked maritime activity has intensified that fear. Washington is trying to pressure Iran without shutting down the global oil system. Iran is trying to prove that pressure on Iran can create pressure on everybody else. That is the economic contradiction at the center of this crisis. The blockade is meant to isolate one country, but the risk premium spreads globally. That is the problem with using pressure in a choke point. The target may be narrow, the market reaction is not. And then there is energy infrastructure. The research pack points to attacks affecting Saudi energy flows and a Qatari gas facility. Even where details vary by source and damage estimates require careful attribution, the strategic meaning is clear. The war is no longer only about ships in a narrow waterway. It is also about the physical infrastructure that moves energy from the region to the world. Ports, pipelines, loading facilities, gas infrastructure, storage sites, and maritime routes are all part of the same nervous system. And once that nervous system looks vulnerable, markets react. That is what separates this from a normal oil spike. A normal spike can come from supply discipline, inventories, demand surprises, refinery issues, currency movements, or an OPEC dispute. This one is tied to war risk across multiple layers: transit routes, ports, pipelines, gas facilities, naval rules of engagement, insurance markets, diplomatic breakdown. It is not one pressure point. It is a network of pressure points. And when multiple pressure points activate at once, prices can move faster than the public expects. For consumers, the first visible impact is fuel. Gasoline, diesel, heating oil, aviation fuel, and freight costs all respond to crude prices with different timing. Some effects are quick, others pass through slowly, but the direction is obvious. When energy gets more expensive, the economy becomes more expensive to run. There is no clever slogan that changes that math. You can call it a geopolitical shock, a supply shock, or a market repricing. At the household level, it still becomes a bill. Diesel may be even more important than gasoline. Gasoline hits the driver. Diesel hits the entire shelf. Diesel moves trucks, ships, agricultural machinery, construction equipment, generators, mining operations, and heavy industry. When diesel costs rise, the price of moving goods rises. That means food, retail products, building materials, medical supplies, industrial inputs, and imported goods can all become more expensive. Oil inflation does not stay inside the energy category. It travels quietly, stubbornly, and through almost everything. This is the problem central banks hate most. If inflation comes from overheated demand, interest rates can cool spending. But if inflation comes from war-driven energy scarcity, raising rates does not reopen Hormuz. It does not repair pipelines. It does not remove mines. It does not make tankers safer. A central bank can crush demand. It cannot escort tankers through Hormuz. Monetary policy can suppress spending, but it cannot produce missing barrels. That is the trap. That is why this moment deserves more than a headline about crude prices. If you want clear breakdowns of how geopolitics becomes economic pain, subscribe to Signal Drop. Because the real story is not just oil at $105. It is the return of a word policymakers hoped they had buried: stagflation. Stagflation is what happens when prices rise while growth slows. It is one of the ugliest combinations in economics because the usual solutions fight each other. Cut rates to support growth, and inflation may get worse. Raise rates to fight inflation, and growth may weaken further. War-driven oil shocks push policymakers into that trap. They raise costs at the same time they weaken confidence. That is why this kind of shock is so hard to manage. It attacks the economy from both sides. The 1970s are the historical ghost behind this story. The world today is not the same as the 1973 oil embargo. Energy systems are more diversified. Strategic reserves exist. Markets are deeper. The U.S. is a major producer. Many economies are less oil-intensive than they were 50 years ago, but the political lesson still applies. When energy prices surge suddenly, governments lose control of the economic conversation fast. The 1970s are not repeating exactly, but they are echoing loudly enough for policymakers to hear them. Voters do not experience oil through futures contracts. They experience it through commuting costs, grocery bills, airline fares, delivery fees, heating bills, construction costs, and wages that suddenly feel smaller. That is why energy inflation is politically explosive. It is visible. It is repetitive. People pay it every week. And unlike a stock market correction, it does not feel distant from normal life. When fuel rises, people do not need an economist to explain inflation. They see it at the pump, then they see it again at the store. Once oil becomes a war price instead of a market price, every country experiences the shock differently. Developing economies face the sharper pain. Wealthy countries can absorb higher fuel prices with subsidies, reserves, currency strength, and fiscal tools. Poorer import-dependent countries have fewer cushions. They pay more for energy in dollars, often with weaker currencies and tighter budgets. For them, a $105 oil world can become a balance of payments problem. The same oil price that is painful for a rich country can become destabilizing for a fragile one. That is where the crisis spreads into food security. Oil affects fertilizer, shipping, storage, irrigation, refrigeration, and transport. If fuel prices rise, food systems become more expensive. If currencies weaken at the same time, imported food becomes even harder to afford. A war in the Gulf can end up raising bread prices in countries that have no role in the conflict. That is the brutal reach of energy inflation. It punishes distance, it punishes dependence, and it punishes countries that did not start the crisis but still have to pay for it. Europe has a different vulnerability. Since Russia's invasion of Ukraine, European governments have spent years trying to reduce energy dependence on hostile or unstable suppliers. They have adapted, but adaptation is not immunity. Higher oil and gas prices still hit industry, households, transport, public finances, and political stability. Europe can survive the shock. That does not mean it escapes the cost. Energy security improved after Russia, but Hormuz is a reminder that the map still has more than one pressure point. Asia is even more exposed to Hormuz. Major economies such as China, India, Japan, and South Korea depend heavily on Gulf energy flows. Some have reserves, some can seek alternative supplies, but they cannot instantly redesign global energy routes. If Hormuz stays constrained, Asia's industrial machine becomes more expensive to operate. Asia does not just pay more for energy, it pays more to manufacture the world's goods. And when that happens, the cost does not stay in Asia. It moves through global supply chains. This creates a diplomatic problem for Washington. The United States wants allies and partners to support pressure on Iran, but many of those same partners are the ones most exposed to higher oil prices. A government can agree with Washington's security argument and still be furious about the economic cost. Alignment becomes harder when voters start paying the bill. That is the quiet problem with economic pressure. The strategic target may be Iran, but the political pain can land on partners. It also creates a quiet advantage for some producers. Oil exporters outside the immediate danger zone can benefit from higher prices. Russia, for example, could gain revenue from elevated crude prices, even while facing sanctions and diplomatic isolation. That is one of the darker ironies of this crisis. A war involving Iran can improve the fiscal position of another U.S. adversary. Energy markets do not reward the morally deserving, they reward the positioned. And right now, high prices create uncomfortable winners. Saudi Arabia and the Gulf states face a more complicated picture. Higher oil prices can increase revenue, but attacks, transit disruption, insurance risk, and regional instability threaten the infrastructure that makes those revenues possible. For Gulf producers, the ideal situation is high prices without physical danger. The current situation risks delivering the price, but also the danger. That is not a clean win. It is a profitable risk, and profitable risks can still become strategic nightmares. OPEC's role becomes more difficult in this environment. In a normal market, producers can adjust output to manage supply and price. But when the bottleneck is transportation security rather than production capacity, pumping more oil is not enough. A barrel that cannot move safely does not calm the market. Logistics can overpower production policy. That is why this crisis is bigger than an OPEC meeting. It is not only about how much oil exists, it is about whether the world trusts that oil can move. Strategic petroleum reserves can help, but only within limits. Governments can release barrels to ease a temporary shock. They can soften a spike. They can buy time, but they cannot replace an extended closure of a major maritime artery forever. Reserves buy time. They do not solve the underlying conflict. If the market believes the disruption could last, reserve releases may soften the blow without ending the panic. A reserve release is a cushion. It is not a peace deal. This is why forecasts now vary so much by scenario. If Hormuz partially normalizes, prices could ease. If talks restart and shipping confidence returns, the risk premium could shrink. But if seizures continue, mines remain a threat, infrastructure attacks expand, or insurance costs keep rising, prices can stay high or move higher. The market is not pricing one future. It is pricing a menu of bad possibilities. That is why the number on the oil chart matters less than the reason behind it. Here is the real analytical payoff. The oil shock is not only a supply shock, it is a confidence shock. The world has to believe energy can move safely, consistently, and predictably. Once that belief breaks, even partial disruption can produce outsized effects. Energy markets run on barrels, but they also run on trust. And trust is harder to rebuild than production capacity. That trust is now damaged. Shipping companies are asking whether routes are safe. Insurers are asking whether risk models still hold. Refiners are asking whether cargoes will arrive on time. Governments are asking whether reserves are enough. Central banks are asking whether inflation will reaccelerate. Consumers are asking why prices are rising again. Every question points to the same problem. The market is no longer just calculating supply, it is calculating fear. And this is where the political cost becomes unavoidable. Leaders spent the last 2 years telling voters inflation was being tamed. Now, a war-driven energy shock threatens to reopen the wound. Even if economists can explain the difference between core inflation and energy inflation, voters do not live inside technical categories. They live inside monthly bills. They do not ask whether inflation is core or headline. They ask why the same paycheck buys less. That is the political danger. That matters for elections, budgets, and alliances. If fuel prices stay high, governments face pressure to subsidize energy, cut taxes, release reserves, pressure oil companies, impose price controls, or blame foreign actors. Every option has costs. Subsidies strain budgets. Tax cuts reduce revenue. Price controls distort supply. Reserve releases are temporary, Blame may buy time, but it does not lower the pump price by itself, and voters eventually notice when explanations do not become relief. Central banks will also face a communication problem. If they ignore the oil shock, they risk looking soft on inflation. If they respond too aggressively, they risk deepening the slowdown. The credibility they rebuilt after the last inflation wave could be tested again, and this time the source of inflation sits outside their direct control. That is the nightmare scenario for monetary policy. A central bank can explain the shock, it can model the shock, it can talk around the shock, but it cannot remove the shock. That is what makes this crisis so dangerous for the global economy. It is not one isolated number on an oil chart. It is a pressure system moving through shipping, inflation, growth, politics, diplomacy, and war strategy. Each layer reinforces the next. Higher oil weakens growth. Weaker growth raises political pressure. Political pressure narrows diplomatic room. And narrower diplomatic room can keep the crisis alive. That is how an oil shock becomes a strategic feedback loop. The real question now is duration. Not whether oil briefly touches a headline number, how long the risk premium lasts. A short spike hurts. A prolonged spike changes behavior. Companies delay investment. Consumers cut spending. Governments adjust budgets. Central banks become cautious. Businesses rewrite forecasts. The longer the shock lasts, the more it becomes part of the economic baseline. And once a shock becomes baseline, it stops being temporary. And if this is the kind of deeper economic analysis you want, subscribe to Signal Drop and share this with someone watching only the oil price, because the chart is only the surface. Underneath it is a war, a blockade, a shipping crisis, a central banking dilemma, and the possibility that the global economy is entering a slower, more expensive phase. This is not just about crude, it is about the cost of uncertainty spreading through the entire system. The mistake would be treating this as just another commodity cycle. Commodity cycles rise and fall. War shocks can change policy, alliances, budgets, and public opinion. If the Iran conflict keeps energy prices elevated, the effects will show up in trade balances, election campaigns, corporate earnings, central bank decisions, and diplomatic negotiations long after the first headlines fade. A commodity cycle changes prices. A war shock can change strategy. That is the difference. That is the part officials will try to manage carefully. Nobody wants to tell the public that a foreign war could make domestic prices rise again. Nobody wants to admit that monetary policy has limits. Nobody wants to say energy security still depends on geography. Nobody wants to explain that global supply chains still rest on narrow sea lanes. But Hormuz is forcing that old lesson back into the open. The modern economy is digital, financial, and global, but it still runs through physical choke points. The next phase depends on three signals. First, whether shipping volumes through Hormuz begin to recover. Second, whether insurance rates and freight costs ease. Third, whether oil prices hold near current levels or fall as diplomacy returns. Watch those indicators more closely than speeches. Markets often reveal confidence before politicians admit it. If ships move, insurers relax, and prices fall, the panic may fade. If those signals do not improve, the crisis is still alive beneath the statements. Also, watch Asia. If Asian refiners, governments, or shipping firms begin making emergency adjustments, that will tell us the crisis is moving from fear into operational disruption. If they absorb the shock calmly, the market may stabilize. But if cargoes are delayed, alternative supplies become crowded, and governments start competing for replacement energy, the pressure can compound quickly. Asia is the test. Because if the region that depends most on Gulf flows starts acting like supply is no longer reliable, the rest of the world will feel it. For the United States, the economic risk is politically awkward. America produces a lot of oil, but it still lives inside global prices. A supply shock abroad can still raise domestic fuel costs. Energy independence does not mean price isolation. That is a comforting myth. But markets are old school. They do not care about campaign slogans. They care about marginal barrels, shipping routes, refinery capacity, and global benchmarks. And when global benchmarks rise, American consumers are not magically protected. For the rest of the world, the lesson is even harsher. The global economy is still built around vulnerable routes, concentrated energy flows, and fragile assumptions about open seas. The world can talk about transition, diversification, and resilience, and those goals matter. But when Hormuz tightens, the old petroleum order proves it still has teeth. This is the old lesson energy markets teach every generation. Geography still prices the modern world. The $105 oil world is not just a price, it is a warning. War has entered the economic forecast. Energy security has returned to the center of politics. Inflation risk is back in the room. And the global economy is being reminded, in the most expensive way possible, that the distance between a naval standoff and a grocery bill is shorter than it looks.